This is Sharon. In today's breaking news, you will come to know information about Polygon Matic, FTX Exchange, Coinbase blacklists 25,000 crypto addresses, anchor nets, etc. Stay tuned till the end of the video so that you will not miss any important updates. Renowned investor Jim Rogers sees the end of the US dollar, says Washington does not play fair anymore. Veteran investor Jim Rogers, who co-founded the quantum fund with billionaire investor George Soros, says that what is happening with the US dollar now is the end of the US dollar. He explained that an international currency is supposed to be neutral, but in Washington, they are now changing the rules, emphasizing Washington does not play fair anymore. Jim Rogers on the end of the US dollar. Renowned investor Jim Rogers discussed the end of the US dollar and the future outlook for cryptocurrency in an interview published by the Economic Times Sunday. Rogers is George Soros' former business partner, who co-founded the Quantum Fund and Soros Fund Management. He was asked about the outlook for the US dollar and where he sees the dollar index headed. I own US dollars partly because when turmoil comes, people look for a safe haven. They think the US dollar is a safe haven for historic reasons, Rogers began. However, the veteran investor added, but what is happening with the US dollar now is the end of the US dollar because an international currency is supposed to be neutral, but in Washington, they are now changing the rules. Now, if Washington does not like you, they put sanctions on you, and you cannot use US dollars, he stressed. So, many countries are starting to look for a competitor, China or Russia or India, Iran, Brazil. Some countries are starting to look for a competing currency, and they should because Washington does not play fair anymore, he continued. Since Russia began its invasion of Ukraine, the United States as well as a growing number of other countries have been placing sanctions on Russia. Russia has about 16% of its reserves in US dollars and 32% in euros. As billionaire investor Bill Miller recently described, they have almost 50% of their reserves in currencies that are controlled by people who want to do them harm. Miller agrees with Rogers that other countries are starting to look for alternative currencies to the US dollar. Rogers added, of course, the US is the largest debtor nation in the world. So, for fundamental reasons and political reasons, people are looking for competing currency. I do not know what it will be yet. I hope I am smart enough to buy it when you find it. I do not like saying it. I am an American, but I do not like to see what they are doing to the American dollar, he opined. Jim Rogers still concerned governments may outlaw Bitcoin and other cryptocurrencies. Rogers was also asked, can cryptos ever be an alternative to the US dollar index? He replied, well, it could be. Many people have made a lot of money trading crypto. He explained that crypto bulls say that cryptocurrency will be the new money. I know that every country in the world is working on computer money now, including the US, he pointed out. However, he said that the US will not say it is new money. Regarding cryptocurrency, he noted that governments like control and governments like monopoly. The veteran investor elaborated, I do not like it, but that is the way governments are, and I just suspect that they will either tax it or regulate it or outlaw it or something because they do not want to lose control. Rogers has warned that governments could ban cryptocurrencies on several occasions. He said it is the reason he did not invest in Bitcoin. However, in May last year, he said he regretted not investing in BTC. What do you think about Jim Rogers' comments? Let us know in the comments section below. Polygon includes $23 billion sports betting company DraftKings as a network validator. Ethereum scaling solution Polygon includes the Nasdaq-listed DraftKings sports betting company as a network validator on the Polygon network. It's the first time a major publicly traded firm has taken an active role in blockchain governance. Valued at $23 billion, DraftKings, a digital sports, entertainment, and gaming company, today joins the Polygon ecosystem as a validator and node operator, marking this the first time a major publicly traded firm has taken an active role in blockchain governance. Polygon validators are responsible for verifying the authenticity and validity of transactions on the network and earn rewards in return in the blockchain's proof of stake (POS) mechanism. All validators stake Polygon's native Matic tokens as collateral for the right to run nodes, a fundamental part of the POS blockchain's infrastructure. As part of the agreement to become one of the network's validators, DraftKings has teamed up with the digital assets infrastructure provider Zero Hash to become one of Polygon's 100 validators whose job includes producing blocks, validating consensus, and committing checkpoints to the Ethereum ETH mainnet. Polygon validators have earned $770 million in rewards. According to the press release, more than $2.67 billion of Polygon's Matic tokens worth over $4 billion have so far been staked by Polygon validators, who have earned close to $770 million in rewards to date. DraftKings will take its place among existing validators as an equal community member, solidifying our desire to achieve a decentralized, community-run consensus network, said Sandeep Nelwal, co-founder of Polygon. Over the past couple of years, Polygon has emerged as an important part of Web3 infrastructure by providing an Ethereum virtual machine (EVM) compatible sidechain and scaling solution bolstering high transaction speeds and low fees compared to the Ethereum base layer. An important milestone for the blockchain industry. As per the press release, Polygon is home to some of the biggest projects in this space, from decentralized finance protocols such as lending platform Aave to luxury brands company Dolce and Gabbana and non-fungible token (NFT) marketplaces including OpenSea and Mark Cuban's Lazy.com. More than 7,000 decentralized apps are currently building on Polygon, making it a popular destination for Web3 projects. While large corporations have shown increasing interest in the nascent Web3 economy, most participation until now has been limited to investments and promotional campaigns. The decision by DraftKings to take an active role in the day-to-day operations of a major crypto network is an important adoption milestone for the blockchain industry. DraftKings has announced several Web3 initiatives in the past year, including launching its mainstream accessible NFT marketplace featuring collections from Autograph, a strategic relationship with the Polygon blockchain, and an upcoming NFT-based game alongside the NFL Players Association. Future-proof aspects of our business in the Web3 era. Gaining exposure to staking technology supports DraftKings' broader strategy of building out a robust, sustainable, and decentralized infrastructure to help future-proof aspects of our business in the Web3 era, said Paul Liberman, co-founder and president of Global Product and Technology at DraftKings. Polygon's suite of products offers developers access to major scaling and infrastructure solutions such as Layer 2 solutions like ZK rollups and optimistic rollups, sidechains, hybrid solutions, and more. Looking ahead, Polygon is making major investments into zero-knowledge cryptography, a technology widely seen as the end game for blockchain scaling. The core development team made it a centerpiece of its strategic vision in the zero-knowledge thesis published in August. As part of that mission, the team has committed $1 billion, a significant portion of the treasury, to ZK-related efforts. Anchor nips at Aave's heels as DeFi protocol becomes second largest lending application. While the decentralized finance DeFi platform Anchor Protocol's native digital asset ANC has gained more than 180% over the last month, the total value locked (TVL) in Anchor has increased a great deal during that time as well. Anchor Protocol is currently the second largest DeFi lending platform in terms of TVL, and over the last month, Anchor's TVL has increased by 40.13%. Anchor TVL surges more than 40% in 30 days. Protocol's TVL rivals Aave's lead. The Terra-based token Anchor Protocol (ANC) has increased in value significantly against the US dollar during the last month. At the time of writing, 14-day metrics show ANC has gained 82.7%, and 30-day stats indicate ANC is up 182.4%. Anchor is a lending protocol built with the Terra blockchain network, and it gathers liquidity from lenders and borrowers. Moreover, lenders depositing the stablecoin Terost, USD, gather a stabilized yield at close to 20% APY. In order to gather yield, Anchor uses a liquid staking mechanism. Anchor and Orion Money also offer Ethanchor, which allows depositors to gather yield on Ethereum-based stablecoins in contrast to Anchor's USD functionality. Currently, Anchor is the sixth largest DeFi application today, out of all the DeFi applications in existence according to DeFilama. Metrics. Anchor's TVL has increased 5.55% over the last week, but monthly statistics indicate the protocol's TVL jumped 40.13% since last month. Much of Anchor's TVL increase to $11.5 billion occurred during the last 30 days. In terms of the 124 lending applications, Anchor is now the second largest DeFi lending protocol under Aave. The lending protocol Aave is just a hair above Anchor, as Aave currently has a TVL of around $11.6 billion. Below Anchor, in terms of lending DeFi apps by TVL, include protocols like Compound, $6.48 billion, Justlend, $1.86 billion, Venus, $1.62 billion, Bunky, $1.11 billion, and Iron Bank, $1.06 billion, respectively. Anchor metrics also show there is $2.46 billion borrowed by borrowers today, and people in debt have to leverage bonded Luna or bonded ETH for collateral. Anchor's documentation says that the DeFi lending protocol has 3 audits. One audit published by Cryptonics goes over Anchor's smart contracts, and another audit by Cryptonics reviews Anchor's distribution of ANC and smart contracts. Furthermore, last July an Anchor audit report was published by the team at Solidified. What do you think about Anchor moving up the ladder to the second largest DeFi lending application today? Let us know what you think about this subject in the comments section below. The CEO of FTX US explains why you can't use exchanges to avoid sanctions. Crypto exchanges registered in the US must take a hardline approach when instating sanctions required by the government. Brett Harrison, the CEO of FTX US, said that recent public assertions that crypto is an effective means of evading sanctions couldn't be more wrong. Harrison said that regulated cryptocurrency exchanges have advanced technology and effective procedures for enforcing AML and sanctions, making them an improbable road for moving sanctioned money. AML and KYC regulations leave no wiggle room for sanctioned users. According to Harrison, FTX US and all other exchanges registered in the US are required to collect identifying information of every user, including name, date of birth, phone number, social security number, and photo ID. All of the information an exchange collects is then cross-checked against government databases to ensure that the name given by the user matches their social security number. If the exchange can't verify the integrity of the information, the user is automatically rejected from the platform and prohibited from trading. Users who get their identity verified are then checked against all sanctions lists and watch lists. FTX US checks the U.S. Treasury's Office of Foreign Assets Control (OFAC) list, the Department of Justice's FBI wanted list, and the United Nations Consolidated Sanctions list. If found in any of those lists, the user's registration application is rejected. Going through the first two verification steps doesn't mean a user is safe from additional controls, Harrison said. He noted that FTX US and other exchanges also monitor users' fiat transactions. Deposits or withdrawals from sanctioned banks or other blacklisted sources are blocked, and the user's account is locked. FTX US uses the same on-chain risk and transaction monitoring tools that other government agencies in the US use, Harrison said. These tools have databases of known sanctioned addresses, heuristics that determine geographic locations, and machine learning algos that identify suspicious patterns in transfer histories. If we detect suspicious activity, we block the user from moving assets, he explained. Cryptocurrency exchanges have extremely advanced technology and effective procedures for enforcing anti-money laundering (AML) regulations and sanctions. When combined with the transparent nature of blockchain technology, this means that using centralized, regulated cryptocurrency exchanges to move funds undetected is an impossible task. Recent allegations that Russian companies and individuals would resort to cryptocurrencies to avoid the crippling sanctions imposed by the West have little to no merit. Even if they were to use decentralized exchanges, unregulated OTC desks, or even peer-to-peer transfers, the movement of a large amount of funds on the blockchain would alert both the industry and the authorities, potentially leading to a downward market move that would reduce the value of the transfer. Coinbase blacklists over 25,000 crypto addresses tied to Russian individuals and entities. The cryptocurrency exchange Coinbase has addressed the company's procedures toward complying with sanctions in a blog post published on Sunday. The crypto firm says that respecting sanctions plays a vital role in promoting national security, and the acts can help deter unlawful aggression. Coinbase intends to comply with international sanctions. Chief Legal Officer says digital assets have properties that naturally deter sanctions evasion following the statements of the two chief executives from two of the largest crypto exchanges on the planet. Coinbase has published a blog post concerning the company's goals toward promoting sanction compliance. The post was written by Coinbase Chief Legal Officer Paul Grewal, and it touched upon the current conflict in Ukraine. Essentially, the gist of the article highlights that Coinbase is committed to complying with sanctions. In the past few weeks, governments around the world have imposed a range of sanctions on individuals and territories in response to Russia's invasion of Ukraine, Grewal's post details. Sanctions play a vital role in promoting national security and deterring unlawful aggression, and Coinbase fully supports these efforts by government authorities. Sanctions are serious interventions, and governments are best placed to decide when, where, and how to apply them. The Coinbase executive's post further explains that crypto assets have specific properties that naturally deter common approaches to sanctions evasion. This is due to the fact that most blockchains are public, auditable, and traceable. As far as traceability is concerned, Grewal says when applied to public blockchain data, analytics tools offer law enforcement additional capabilities. Moreover, blockchains have permanence, Grewal's blog post summarizes, as the chief legal officer states. Once recorded on the blockchain, transactions remain immutable. No one, not crypto companies, not governments, not even bad actors, can destroy, alter, or withhold information to evade detection. Coinbase has blocked more than 25,000 addresses tethered to Russian individuals and entities. The Coinbase blog post is very much aligned with the large number of corporate entities complying with sanctions and cutting ties with Russia. Over the last 13 days, companies such as Netflix, Apple, Google, TikTok, BP, Exxon, Equina, Shell, Boeing, Airbus, Ford, Renault, Mercedes-Benz, Toyota, Visa, MasterCard, American Express, Dell, Meta, IKEA, and Nike have complied with international sanctions or cut ties with the Russian Federation. Grewal notes in the company blog post that sanctioned individuals or entities are checked for during the onboarding process at Coinbase. The crypto company leverages sanction lists maintained by the United States, United Kingdom, European Union, United Nations, Singapore, Canada, and Japan. Additionally, Coinbase has sophisticated technology that can anticipate threats, Grewal disclosed. Coinbase maintains a sophisticated blockchain analytics program to identify high-risk behavior, study emerging threats, and develop new mitigations, the firm's chief legal officer said. Presently, the exchange blocks thousands of blockchain addresses related to individuals or entities stemming from Russia. Grewal's post explains. Today, Coinbase blocks over 25,000 addresses related to Russian individuals or entities we believe to be engaging in illicit activity, many of which we have identified through our own proactive investigations. Once we identified these addresses, we shared them with the government to further support sanctions enforcement. The Coinbase executive ends the post by saying the firm aims to help people protect and build wealth, but at the same time, security, safety, and transparency are important foundations. Our commitment to sanctions compliance is part of the process, the Coinbase blog post concludes. What do you think about the Coinbase blog post regarding the company's commitment to sanction compliance and how it has blocked 25,000 addresses stemming from illicit Russian activity? Let us know what you think about this subject in the comments section below. Thank you for watching. Subscribe to our channel and press the bell icon for regular notifications when we post a new video.